You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Good to be with you and good to be with our listeners.
Wow, what a start to the week. The biggest drop in Dow history, and then 2 days later, you have the biggest bounce back. What's going on there, Bob?
Well, I don't know. I think if you were in Europe or something like that and speaking a different language, you would have to say volatility. When the markets had become extremely complacent. You know, traders were trading on the minor moves, but the bulk of the trade was complacent. The trend was their way. The Fed talked about raising the discount rate, but that wasn't going to happen. You had the comfort of imagining wonderful management and at companies, because the only companies you own, of course, are ones with wonderful management. And then the Fed is going to back up and make sure that nothing goes wrong. So, hey, complacency all over the place, and that shows up in a very low VIX, the volatility indicator, which stayed down very low for a long time. And then they were also in the U.S. and Canada quite ignoring the problem in China. As a matter of fact, people were saying that it could be isolated. And BNN here a couple of weeks ago, there was a portfolio manager there saying, well, look at Hong Kong index is down 20%, but the shares in Hong Kong that I own are unchanged. Therefore, I'm wonderful, you know. But a market is a market, and although there are individually brilliant stocks there, and you also have the condition whereby there are investment-grade stocks, but when they are bid up to speculative highs, those are no longer investment-grade stock prices, so they have a tendency to get in line. So anyways, as we looked for it, the speculation in the Shanghai market, we needed to conclude the move would be another set of upside exhaustion reading, and also we used the historical pattern that it would likely conclude in June. So we got one reading on that, not a cluster of them, but that was enough to do it, and the high was June the 12th, and then it got hit pretty hard because you had a highly leveraged traders in the thing, and a lot of new accounts in the game. So, and then it finally caught up with the North American markets, and so the next leg down in Shanghai really did take the bid out of the North American markets. And yes, there was, I think, on one day somebody counted all the swings and ended up like about 2,500 Dow points between the ups and downs, you know, down 1,000 points, up 1,000 points, and etc. So let's first of all look at this thing. The Shanghai market has replicated the great blow-offs in history, like the South Sea bubble in 1720 had its high in June, and you also had European markets setting their high, say 1873 bubble and 1929 bubble in May or June of the year. Then the new game in town began in 1873 when the New York market was big enough to be worthwhile, and then it took where Europe and London had their high in May, June. New York gave the final rush up into September and then expired. And then again, that was the case in 1929, where Europe set its highs in May or June, and then New York set a high on early September. So there seems to be a positive pulse come through into early September when you're in a market that is fully speculated like this one has been. So now the volatility, the ups and downs on this is that you also have an arbitrary player in the market with the New York or the U.S. Fed, and there's that fund, I forget they call it, the President's Fund, that they can intervene from time to time, and perhaps that was on. You also have this high-frequency trading, which can make things rather bizarre, and then you've had the complacency, so it makes for the start of terrific violence, which we're getting here. So, but at any rate, things did come down. In our piece yesterday, we noticed that the commodities were very weak and could have a relief rally. Copper can do a little seasonal rally into September. Wheat can do a seasonal rally into late August. And so we looked at that and thought, so we're getting got a huge rally here in crude oil, 38 to 45 or something like that. big move, so they're squeezing the shorts there. But in looking at the seasonals on these key commodities, they can be all much lower later in the year. Typically, crude oil sets an important low in December or January. Copper can set a low in November, as does wheat. So relief rally here for a bit, and it looks like we're getting it. The other one that's been really moving around has been the long Treasury bond as a flight to quality. And we look at the TLT on this one. And it was back down in June and July, sort of setting a base at around the 115 level, and that's where we thought, well, we think it can rally initially to 120, and then there was a fair amount of overhead resistance around the 123 to 124 level, which it got to. And then, of course, when the New York stock market got hit, then that prompted a run to long treasuries, because it's been a trade that's been on actually since 1987. Now, historically, the flight to quality really is the safest item, which is treasury bills. But in all these decades, it's become a counter trade where you then can, rather than parking your money in treasuries and getting no price change, or in treasury bills and getting no price change, you'd buy the long end and get the price change. So, anyways, this ran up to 128, and our technical work last week was that it was generating a reverse springboard pattern and overboughts and everything else. So then once the stock market stabilized, you then had that TLT did a huge swing from 128, almost 129, right down to 121, and now trading at 123. So this probably was an important high for treasuries, because let's say that for three serious setbacks in the stock market, the game has been the counter trade at buying long treasury, and it became in late January. Remember, we had a paper we called Ending Action on the long treasury and also on European bonds as well, that when they peak, this would likely be a cyclical or maybe even a secular peak. And you had the peak in the long bond then at the end of January. Then European bond market, as monitored by the German yield, it had an exceptionally unusual low yield in I think it was April the 9th, and then it's had a change too. So anyway, I think this has been an important rally. It was rallying on something that's worked definitely 3 times, and a lesser degree on the 4th time. That was in 1987. So the street knows that the counter trade in treasuries, but maybe it won't work this time, which will be interesting from a technical point of view. And then you also had a widening of credit spreads, and you recall that we were looking for them to narrow into May or June, and spreads did now. This would be U.S., the difference between low-grade corporate bonds and long-dated treasuries, did narrow into May and started to reverse. We'd call that on schedule, and it should do a first breakout in early July, which it did, and then a more serious breakout to widening in late July, early August. Well, that didn't come until August the 13th, when it had to get above 213 basis points, which was the extreme in January when crude oil was crashing. And it did, I think it was August 15th, and it got to 219, and that was moving, and then it jumped up to 228 here with some drama, and that was, of course, right associated with the selling pressures on the New York Stock Exchange. So we have the right recipe, and I'm going to emphasize that this pattern in credit spreads widening and then doing the 2 breakout is very similar to what happened in 2008 that set up the crash, and then in 2007 the same pattern started the credit contraction. And then back in 1998 we used it then, the same technique, to watch for the change in credit spreads, and that then ended up setting off the long-term capital management disaster, $4.5 billion collapse of a hedge fund, which was very dramatic. So that is a reliable indicator, and it's working now. Now, this so far says on each of these previous examples that led to very serious credit contraction in the fall of the year. So little sunshine now, maybe into early September, and then if spreads start the next leg up, it's going to be trigger off some very heavy selling. And it's also worth mentioning here that I think the central bankers have fully spent all of their bullets in trying to keep the markets going up, and they're out of them now at the time when the season turns bad. So I think that it's going to put a very bad light on central bankers and all of their manipulations and theories and all that sort of stuff.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye. Bob, what's the outlook for crude oil and gold?
Yep, those are two items that we like to watch. Now, crude oil, it reached its super peak in 2008 when the peak oil story was paramount. And the technicals, that rally was so outstanding that it triggered off a weekly upside exhaustion, and we had noted that if it triggers that off, it'd be more than a cyclical bear, it'd be a secular bear. So then a few years ago, you had crude oil hanging up better than most commodities because you got the Middle East risk premium providing an extra bid. And so then it finally caught up. Now in 2014, we were looking for crude to rally out to around May, and then after that it could likely fail, and we used it in gold terms that the price would, from its high crude relative to gold, it could fall to around 25% of the high. So if you were, then say 100. So we had a rough estimate for the low on crude of about $25, and when we got down to 37 the other day, that's getting fairly close to it. I think that is real and can be accomplished on the next seasonal decline, which may end in December. So there's that one, and then on gold, it's been impossible, except for very nimble traders, for people to make money in gold in dollar terms. The last rally we had for the precious metal sector was likely to run from around December to around May. The first rally was actually too quick, too soon. But anyways, the last sell signal we had on the sector was in May. And the problem in trying to make money out of gold in U.S. dollars is that in a post-bubble contraction, the senior currency, which is still the U.S. dollar, becomes chronically strong relative to most currencies and most commodities for a lot of the time. And that's what's been happening. So the old paradigm, which has been around actually since the 1960s, was that the Fed was evil, it would depreciate the dollar, and gold would go to, pick a number. And if the higher the estimate you made, like those that were calling for $10,000 gold, it seems to be that the higher the estimate you made, the more famous you became on the gold circuit. Of course, that didn't work out. And but the only salvation for gold here is that it's unique liquidity, and nobody else owes it. So then when you're in a financial distress, the really serious money goes to the most liquid items, and that T-bills in the senior currency, which is still the U.S. dollar. So you got that bid. And then you also have it buying gold. So you have a bid for gold, but it may not drive it up relative to the U.S. dollar. But where this eventually accumulates for the gold mining sector, and again, this is not my imagination, this is just how gold has worked on 5 previous post-bubble contractions, is that everything falls in price relative to gold. Wages, mining equipment, cost of energy. So here's where we keep looking at gold and crude oil prices, because crude oil is the proxy for energy prices. So these are falling relative to gold. So theoretically, that should be improving profit margins on an operating gold mine. And eventually that will accumulate such that people see that, hey, there is an investment here in gold shares. But in the meantime, if the big market is going to come under more selling pressure, it'll take the gold shares down with it. So we're just standing aside in the precious metal sector, waiting for the opportunity. Now, the advice on gold itself is that one should own some of it as an insurance, but one shouldn't figure out that you're up or down on it. It's just there as insurance. And in the last week and a half, the gold-silver ratio has given us the instruction that it usually does when you're going into a storm. The gold-silver ratio goes up. It's done it where, well, you can look back on 400 years, that when you're going into a financial storm, all of a sudden silver begins to underperform gold. So the target we had was the last high, which was 77 on the gold-silver ratio, and it got up to briefly hit 80 the other day, and it's backed off a bit. So it's got the breakout, and that breakout says there's a financial storm either on, which it was 2 days ago, or about to happen, which may be the case in this fall. So, it's time not to have any debt. It's time to be low exposure in any of these games. And for investors, though, on the fixed income side, we've always recommended that in a storm you should own people park and T-bills, but you're not going to make any money there. But if you're in 3 to 4 year high-grade corporate bonds in the U.S., you get that income. There's minimal risk to it. Plus, you'll get the pickup on the next rally on the U.S. dollars. So, gosh, that sounds like a boring position, but that's what the conditions suggest now on this thing. So,
Bob, thank you very much for chatting with us.
Good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. You can forward questions or comments to the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.